Ever feel like your favorite groceries are suddenly costing way more? You're not alone. In fact, the average American household spent nearly $400 more on food in the last year alone. In this video, we'll break down why those everyday prices are climbing and what you can do to navigate these rising costs. If you find this helpful, consider subscribing. We break down finance news like this every week. Drop a comment with your biggest question about inflation. So let's talk about that sticker shock at the checkout. You reach for your usual brand of coffee or perhaps your go-to electronics, and the price tag makes you pause. This isn't just a random increase. It's often a direct result of complex global forces, like trade tensions. Think of it like this. Imagine your favorite local bakery suddenly has to pay more for flour because of a new tax on imported grain. That extra cost doesn't just disappear. It gets passed on to you, the customer, in the form of a higher bread price. The same principle applies on a much larger scale between countries like the United States and China. When tariffs are imposed or trade agreements shift, it disrupts the smooth flow of goods we often take for granted. This disruption can lead to shortages, increased shipping costs, and ultimately higher prices for the products you buy every single day. We'll explore how these geopolitical shifts impact your wallet and what proactive steps you can take. This is educational content, not financial advice. Ever wondered why that favorite product suddenly costs more? It's not just about the listed price. A complex global network influences what lands on store shelves. This interconnectedness means even small shifts in international relations can ripple outward, affecting everyday expenses. Consider major trade relationships, like that between the United States and China. For years, these two economic giants have engaged in trade, creating intricate supply chains. This intricate dance, however, has seen its share of friction. Tariffs, essentially taxes on imported goods, have been a significant tool in these discussions. For instance, the U.S. imposed tariffs on billions of dollars worth of Chinese goods, leading to increased costs for American consumers. A 2021 Congressional Research Service report indicated that the average American household might have paid over $1.500 more annually due to these tariffs. What happens when these trade tensions escalate? It directly impacts supply chains. Businesses that relied on goods from a particular country might face higher import bills, or need to find entirely new suppliers, a process that takes time and often incurs extra expense. This disruption can lead to shortages or simply higher prices for consumers. Think of it like a plumbing system. A blockage in one pipe can affect the flow throughout the entire house. Furthermore, these ongoing trade dynamics contribute to broader inflationary pressures. When the cost of producing and transporting goods rises due to trade policies or geopolitical uncertainty, that increase is often passed on to the end consumer. This isn't a distant problem. It directly influences the cost of everything from electronics to clothing. So how can one navigate this complex financial landscape? Understanding these global connections is the first step. Diversifying investments, for example, can help mitigate risks associated with any single market or trade relationship. Additionally, managing personal debt effectively provides a buffer against unexpected price increases. Ever wonder why that favorite imported gadget or piece of clothing seems to cost a little more each year? It often comes down to the intricate dance of international trade, especially between major economies like the United States and China. For decades, these two nations have built a deeply intertwined economic relationship, a partnership that has shaped global markets and influenced the prices of goods worldwide. Consider this. China has become a manufacturing powerhouse, producing a vast array of products that Americans consume daily, from electronics to textiles. This has, in turn, fueled American demand for these goods, creating a symbiotic economic flow. However, this interdependence hasn't always been smooth sailing. What happens when disagreements arise between these economic giants? Tariffs, essentially taxes on imported goods, can be a significant consequence. For instance, during periods of heightened trade friction, the average American household has seen increased costs, estimated by some analyses to be upwards of $1.500 annually due to tariffs. This directly impacts the affordability of everyday items. Furthermore, these trade tensions can disrupt global supply chains, the complex networks that bring products from raw materials to finished goods. Imagine a domino effect. A disruption in one part of the chain can send ripples through the entire system, leading to shortages or further price increases. This intricate web of sourcing and production means that geopolitical shifts can have tangible effects on consumer prices. So how does this complex global dynamic translate to personal finances? Understanding these broader economic forces is the first step toward navigating them. The interconnectedness of economies means that events far away can impact household budgets. Consider the morning coffee, a daily ritual for millions. Suddenly, that familiar cup costs a little more. This isn't random. It's often a direct consequence of tariffs. Tariffs are essentially taxes imposed on imported goods, designed to make them more expensive. But why would governments intentionally raise prices? Often, it's a tactic in trade disputes, aiming to protect domestic industries or exert pressure on another nation. For instance, during recent trade tensions, the United States imposed tariffs on billions of dollars worth of goods from China. This immediately meant that products like electronics, furniture, and clothing, manufactured in China, carried a higher price tag when they arrived on American shores. What does this mean for the average household? Research from organizations like the Tax Foundation indicates that tariffs can lead to increased costs for consumers. In some analyses, the average American household could face an additional $1.500 or more annually due to tariffs. And how quickly do these price changes occur? The impact can be swift. Retailers, facing higher import costs, often pass those increases directly to shoppers. This creates a ripple effect, impacting not just the initial imported item, but also potentially raising prices for domestically produced goods that rely on imported components. It's like a stone dropped in a pond, the ripples spread outwards. Have you noticed that the price tags on many everyday items seem to be creeping up? This isn't just a feeling, it's often a direct consequence of how goods move across international borders. When tariffs, essentially taxes on imported goods, are imposed, the cost of bringing those products into a country rises. For instance, the U.S. International Trade Commission has noted that tariffs on goods from China can add significant costs to American businesses. Consider a common scenario. A clothing retailer imports shirts from overseas. If new tariffs are enacted, that retailer must absorb the increased cost or pass it on to consumers. This directly impacts the price paid at the checkout. But the effect doesn't stop at just that one item. When the cost of one essential import rises, it can create a domino effect. Think of it like a ripple in a pond. That initial tariff on imported electronics, for example, might make those devices more expensive. But then, businesses that rely on those electronics for their own production, perhaps a company building computers or assembling appliances, now face higher input costs. This can lead to price increases for a whole range of finished goods, contributing to a broader inflationary environment. According to the Tax Foundation, the tariffs imposed on goods from China could lead to higher consumer prices across various sectors. So how does one navigate this? Understanding these global economic dynamics is the first step. By recognizing how international trade policies can influence domestic prices, individuals can begin to make more informed financial decisions. This knowledge empowers a more resilient financial approach. Have you ever wondered why that favorite gadget or even everyday necessities seem to be costing more than they used to? Often, the answer lies in the intricate dance of global trade. When countries like the United States and China engage in trade disputes, it can create ripples that extend far beyond the headlines, directly impacting the cost of goods. Consider the journey of a smartphone. Many of its components, from intricate microchips to the rare earth minerals essential for its battery, are sourced internationally. Tariffs, which are essentially taxes on imported goods, can significantly increase the cost of these raw materials. For instance, studies have shown that U.S. tariffs on Chinese goods have led to increased costs for American businesses, with some estimates suggesting the average American household pays an additional $1.500 annually due to these tariffs, according to analysis by organizations like the Tax Foundation. This increase in input costs doesn't stay isolated. Manufacturers often pass these higher expenses on to consumers to maintain their profit margins. This is a classic example of a supply-side shock. When the cost of producing something goes up, the price of that product naturally follows. Think of it like a restaurant needing to pay more for its ingredients. Eventually, the menu prices have to adjust. Furthermore, trade tensions can disrupt the steady flow of these components. Factories might face delays or even outright shortages, forcing them to seek out more expensive alternative suppliers or to halt production altogether. This scarcity, coupled with increased costs, creates a perfect storm for rising inflation, affecting not just electronics but a wide array of products we rely on daily. Ever wonder why the price of everyday items seems to climb, even when economic forecasts look stable? It's a question many are asking, and a significant part of the answer lies in the complex world of global supply chains. Consider the journey of a smartphone. The rare earth minerals might come from one continent, the microchips manufactured in another, and the final assembly could happen thousands of miles away. This intricate web, while efficient for decades, has become increasingly fragile. A disruption in one small corner, like a port closure or a trade dispute, can send ripples across the entire system. Did a sudden geopolitical event in Southeast Asia affect the availability of that new gadget? It's highly probable. For instance, the U.S. International Trade Commission noted in 2023 that tariffs on goods from China alone added an average of $1.500 to annual household expenses. This highlights how interconnected global trade truly is. This reliance on specific regions for critical components creates vulnerabilities. When trade relations sour, as seen in ongoing U.S.-China tensions, the impact isn't just felt by businesses. Consumers often bear the brunt through higher prices and reduced product availability. It's akin to a delicate house of cards. A slight nudge can cause the whole structure to sway. What does this mean for financial well-being? It underscores the importance of understanding where goods come from and the potential risks involved. Diversifying an investment portfolio, for example, can help mitigate the impact of sector-specific shocks, much like having multiple suppliers can buffer a business against a single point of failure. Ever wonder why that favorite gadget or piece of clothing seems to cost a bit more lately? This surge in prices can often be traced back to shifts in global supply chains, a complex web of manufacturing and logistics that underpins much of the modern economy. One significant trend emerging from ongoing trade tensions, particularly between the United States and China, is the strategic reassessment of where goods are produced. Companies are exploring two primary approaches to bolster their supply chain resilience: reshoring and nearshoring. Reshoring involves bringing manufacturing operations back to the home country. Nearshoring, on the other hand, means relocating production to countries geographically closer to the domestic market. Consider this, a study by the U.S. Chamber of Commerce indicated that tariffs imposed over recent years have added an estimated $1.500 annually to the cost for the average American household. This illustrates the tangible impact of these trade policies on everyday expenses. What drives this shift? Beyond tariffs, factors like geopolitical instability, rising labor costs abroad, and a desire for greater control over production timelines are pushing companies to reevaluate their global footprints. But what are the broader implications of this manufacturing migration? For instance, the World Economic Forum has highlighted how diversifying manufacturing locations can reduce reliance on single regions, potentially smoothing out price volatility. However, moving production isn't without its challenges. Establishing new facilities and supply networks can incur significant upfront costs, which might, in the short term, be passed on to consumers. Ultimately, these global economic adjustments have a ripple effect. Understanding these dynamics, from trade agreements to the cost of tariffs, empowers individuals to make more informed financial decisions. Ever wonder why that go-to gadget or even everyday household item seems to be costing a bit more lately? It's not just electronics feeling the strain from U.S.-China trade tensions. A surprisingly wide array of consumer goods are experiencing price hikes. Consider the apparel industry. Many clothing manufacturers rely on materials and finished garments sourced from China. Tariffs imposed on these imports directly translate to higher costs for businesses, which are then often passed on to the consumer. For instance, the average American household might see an increase of around $1.500 annually due to these tariffs, according to some analyses. But the impact doesn't stop at visible goods. Have you thought about the components that make up larger products? Think about furniture, toys, or even certain types of machinery. These sectors, often less discussed than electronics, are also entangled in complex global supply chains. When trade flows are disrupted, these seemingly unrelated industries can experience significant price inflation. This ripple effect raises an important question: how do these geopolitical shifts truly affect the economy? Beyond immediate price increases, prolonged trade friction can lead to supply chain instability. Businesses might scramble to find alternative suppliers, which can be a costly and time-consuming process. This, in turn, can contribute to broader inflationary pressures, affecting the purchasing power of savings. What does this mean for managing personal finances in the long run? Ever wonder why that favorite brand of coffee or a specific electronic gadget seems harder to find, or perhaps costs a bit more than it used to? It's not always about simple inflation. Trade disputes, like those between major economic powers, can subtly reshape the marketplace. When tariffs are imposed, businesses often face a dilemma. They can absorb the increased cost, which eats into profits, or they can pass it on to consumers. But sometimes, the calculus leads them down another path, seeking out alternative suppliers. This can mean a shift away from previously favored products. For instance, a 2019 analysis by the U.S. International Trade Commission indicated that tariffs on goods from China could lead to reduced product variety for American consumers. But what happens when companies look for cheaper alternatives to maintain their profit margins? Sometimes the quality of the materials or the manufacturing process might be compromised. It's a bit like choosing a less durable fabric for a favorite shirt to keep the price down. The immediate cost might be lower, but the long-term value diminishes. This isn't a direct policy goal of trade agreements, but it's a very real consequence of market pressures. Consider the supply chain itself. It's a complex web, and disruptions in one area can have cascading effects. A report from the National Bureau of Economic Research in 2020 highlighted how tariffs can force businesses to reconfigure their entire production and distribution networks, which can be costly and time-consuming. These are the hidden costs, the downstream impacts that don't always make headlines. Ever wonder why those favorite products on the shelf seem to be creeping up in price? Often it's a consequence of complex international trade dynamics. For instance, tariffs, which are taxes on imported goods, can directly increase the cost of raw materials and finished products. A report by the U.S. International Trade Commission in 2021 indicated that tariffs imposed by the U.S. on goods from China could increase costs for American consumers. These trade tensions, like those between the United States and China, can create significant ripple effects. They disrupt established supply chains, making it harder and more expensive for businesses to source components and manufacture goods. This disruption, in turn, contributes to broader inflationary pressures. Did you know that some estimates suggest these tariffs could add hundreds of dollars annually to household expenses? So how does this impact personal financial health? Understanding one's own financial standing becomes paramount. This involves a clear-eyed assessment of current income streams, predictable expenses, and any existing debt obligations. It's like taking stock of a ship's inventory before setting sail into uncertain waters. To build resilience against these external economic forces, a proactive approach is key. This often includes diversifying investment portfolios beyond domestic markets, which can buffer against country-specific economic shocks. Furthermore, actively managing and reducing high-interest debt can free up financial resources, providing a stronger foundation to weather unpredictable economic shifts. Have you noticed the price of everyday goods creeping up lately? From electronics to clothing, many favorite products are becoming more expensive. This isn't just random. It can be a ripple effect from complex international trade dynamics. For instance, tariffs, which are taxes on imported goods, can directly increase costs for businesses. Consider the impact of trade tensions between major economies. When tariffs are imposed, the cost of goods often gets passed down the supply chain, ultimately affecting the prices consumers see on store shelves. Data from the U.S. Congressional Budget Office has indicated that tariffs can lead to higher prices for consumers, potentially adding hundreds of dollars to annual household expenses. This is precisely why building an emergency fund is so crucial. An emergency fund acts as a financial buffer, a safety net to catch unexpected expenses before they derail financial stability. Think of it like having a spare tire for a car. It's there for when the unexpected happens, preventing a minor issue from becoming a major breakdown. But how much is enough? Financial experts often recommend saving 3 to 6 months' worth of essential living expenses. This would cover rent or mortgage payments, utilities, groceries, and other necessities. Starting small is key, even if it's just setting aside a small percentage of each paycheck. Automating these savings, perhaps through a dedicated savings account, can make the process more consistent and less of a conscious effort. Have you noticed the price of everyday items creeping up? From the electronics in our homes to the clothes on our backs, many familiar products are becoming more expensive. This isn't just a random fluctuation. It's often a direct consequence of complex international trade dynamics, particularly the ongoing trade tensions between major economies like the United States and China. These trade disputes can manifest as tariffs, which are essentially taxes on imported goods. For instance, studies have shown that tariffs can add hundreds of dollars to the annual costs for the average household. Source: Congressional Research Service analysis of trade data. When tariffs are imposed, the cost of goods imported from the targeted country increases, and this added expense is frequently passed on to consumers. But the impact extends beyond just tariffs. These trade tensions disrupt global supply chains, the intricate networks that bring products from raw materials to finished goods. Imagine a finely tuned machine. When one part is faltered, the entire operation slows down. This disruption can lead to shortages and further price increases. So what does this mean for personal finances? It underscores the importance of a robust financial strategy, and a cornerstone of that strategy is diversification. Just as a farmer wouldn't plant only one crop, an investor shouldn't put all their capital into a single asset. Diversification means spreading investments across different asset classes, like stocks, bonds, and real estate, and even across different geographic regions. This approach helps mitigate risk. If one sector or region experiences an economic downturn, well-diversified investments in other areas can help cushion the impact, much like having multiple streams of income can provide stability during uncertain times. Ever wonder why that imported gadget or even some everyday groceries seem to be costing more than they used to? Often, these price increases can be linked to complex global trade dynamics, like tariffs. Tariffs are essentially taxes on imported goods, and they can directly impact the cost of products for consumers. For instance, studies from the U.S. Congressional Budget Office have indicated that tariffs can lead to higher prices for imported goods, affecting household budgets. But how do these international agreements and trade disputes translate into everyday expenses? When countries impose tariffs on each other, it disrupts established supply chains. Businesses may then have to absorb these added costs, pass them on to consumers, or find new, potentially more expensive, suppliers. This creates a ripple effect, influencing inflation and the overall cost of living. Consider the average American household, which the Tax Foundation estimated could face an additional $1.500 in costs due to tariffs. Given this environment, exploring investment options beyond traditional stock and bond markets becomes a prudent consideration for financial resilience. What if there were ways to potentially buffer against such trade-related volatility? This leads us to consider assets that are more domestically focused, or those that tend to perform differently during periods of global economic uncertainty. One avenue is to look at investments tied to the domestic economy. Companies that primarily operate within a country's borders and rely less on international trade might be less susceptible to tariff impacts. Another area to explore is commodities, such as gold or agricultural products, which can sometimes act as a hedge against inflation and currency devaluation. Furthermore, alternative investments, like real estate or infrastructure projects, can offer diversification. These assets often have different drivers of return compared to public markets, potentially providing a stabilizing influence. The key takeaway is that a well-diversified portfolio, considering a range of asset classes, can be a powerful tool in navigating the complexities of global trade and its impact on personal finances. Consider the everyday items often found in a household. A sudden increase in their price can leave many wondering about the cause. This rise in the cost of goods and services is known as inflation, and it's a key factor influencing interest rates. What exactly drives these price hikes? Complex global trade dynamics, such as tariffs imposed on imported goods, can significantly increase the cost of production for businesses. For instance, the U.S. International Trade Commission reported that tariffs on goods from China alone added billions to the cost of imported products for American businesses. These added expenses are often passed on to consumers, leading to higher prices for everything from electronics to clothing. This economic uncertainty, fueled by fluctuating trade policies, can make central banks hesitant. When inflation is high, central banks may raise interest rates to try and cool down the economy. Conversely, during periods of economic slowdown, interest rates might be lowered to encourage spending and investment. How does this impact personal finances? Higher interest rates mean the cost of borrowing money increases. This affects mortgages, car loans, and credit card debt, making monthly payments more expensive for those carrying a balance. Conversely, for savers, higher rates can mean better returns on savings accounts and certificates of deposit. Given these dynamics, what are some prudent financial strategies? One approach involves diversifying investment portfolios across different asset classes and geographical regions. This can help mitigate the risk associated with any single market or economic event. Another strategy is to actively manage existing debt, potentially by paying down variable rate loans when interest rates are low, or exploring refinancing options when rates become more favorable. Ever wondered why the price of that favorite gadget or even everyday groceries seems to be steadily climbing? It's a question many are asking, and a significant part of the answer can be found in the complex world of international trade. Specifically, ongoing trade tensions between major economic powers like the United States and China have created ripple effects that touch household budgets. Tariffs, essentially taxes on imported goods, can directly increase the cost of products. For instance, studies have indicated that the average American household may experience an additional cost of around $1.500 annually due to certain tariffs, according to analyses from organizations like the Tax Foundation. These tariffs disrupt established supply chains, forcing businesses to find alternative, sometimes more expensive, sources for their materials or finished goods. This isn't just about electronics. It can impact everything from textiles to agricultural products. What does this mean for managing personal finances? When costs rise across the board, it can put a strain on savings and make debt repayment even more challenging. This is where proactive debt management strategies become crucial for increasing financial flexibility. Consider the debt snowball method, where individuals pay off their smallest debts first to build momentum, or the debt avalanche method, which prioritizes paying down debts with the highest interest rates to save money in the long run. These systematic approaches can significantly reduce a debt burden over time. Furthermore, understanding how global events influence local economies empowers individuals to make informed decisions about their financial future, ensuring greater resilience against economic uncertainties. Have you ever noticed your favorite imported snacks or electronics suddenly costing more? This often stems from shifts in global trade. For instance, the trade tensions between the United States and China, which escalated significantly in recent years, have had a tangible impact on consumer prices. Tariffs, essentially taxes on imported goods, can add to the cost of production, and these expenses are frequently passed on to the consumer. Consider the data. According to some analyses, U.S. consumers faced an additional cost of approximately $1.50 for every $1,000 spent on goods subject to tariffs during certain periods. This isn't just about a few extra dollars. It's a systemic effect on inflation. When the cost of raw materials and finished goods rises due to trade barriers, it contributes to broader price increases across the economy. But how do these international disputes translate into everyday expenses? It's largely through disruptions in supply chains. Many products we rely on are assembled from components sourced from multiple countries. When trade routes become more expensive or restricted, businesses must find alternative, often costlier, suppliers or absorb the increased tariffs themselves. What does this mean for personal finances? It highlights the importance of staying informed. Understanding how global economic developments, like trade agreements and tariffs, can influence inflation and the cost of goods is the first step. This knowledge empowers individuals to adapt their financial strategies. For example, a strategy to mitigate these effects could involve diversifying investments beyond domestic markets. As global economic conditions are interconnected, having exposure to different regions can offer a buffer against localized trade disputes. Furthermore, managing personal debt effectively becomes even more crucial when the cost of living is on the rise, providing greater financial resilience. Have you ever wondered why that favorite imported gadget or piece of clothing seems to cost more each year? Often the answer lies in the complex world of international trade, specifically the ongoing trade tensions between major economic powers like the United States and China. These aren't just abstract policy debates, they have tangible effects on everyday prices. When tariffs are imposed, essentially taxes on imported goods, businesses face higher costs. These costs are frequently passed on to consumers. For instance, studies have indicated that American households might see an increase of around $1.5 annually due to tariffs, according to analyses from organizations like the Congressional Research Service. This directly impacts the cost of goods, from electronics to textiles. Beyond tariffs, these tensions can disrupt global supply chains. Imagine a finely tuned engine, where one small part is suddenly unavailable. That's akin to a supply chain disruption. When shipping routes become uncertain or production facilities face restrictions, the flow of goods slows, leading to shortages and further price hikes. This unpredictability can make long-term financial planning feel like navigating a storm. So how can individuals build financial resilience against these global economic shifts? A core strategy involves diversification, not just in investments but also in consumption. Spreading investments across different asset classes and geographic regions can buffer against sector-specific downturns. Think of it like not putting all your eggs in one basket. Furthermore, managing personal debt is crucial. High-interest debt acts like a constant drain, making it harder to absorb unexpected costs. Prioritizing debt reduction can free up financial resources, offering greater flexibility when prices rise or incomes fluctuate. Ultimately, proactive financial management, including diversified investments and controlled debt, provides a strong foundation for long-term security.